bonds don't have any intrinsic value in this new world. Doesn't mean they're bad investments. They're anchor in people's portfolios. But the Fed passionately wants inflation to go up, and there will be no tightening until inflation does go up, and then you'll have a bear market in bonds. So actually, I think the big asset class is the risk area, and particularly equities, which is being reflected in the marketplace today, is the Fed wants this economy to run hot. That's good for equities versus bonds, full stop.
What if you're already worried that the market is running a little too hot?
Well, I think the market is incredibly hot. It's the only game in town, and there's no obvious catalyst to keep it from going even higher. Bull markets don't tend to stop just because they're fully valued. They tend to stop when you get to an extreme, and also there is a catalyst going the other direction. So the object in motion most likely will stay in motion, and it's a bullish day for Wall Street.
Hey, Paul, what is the message today to Americans who don't have a lot of assets in terms of equities, don't own a home, and might be structurally unemployed for a long time?
I think the important message there is entirely away from the impact of what Jay had to say on Wall Street. The big issue is the Fed really wants to nurture a strong recovery for Main Street. It is putting in place the apparatus for Wall Street to understand that. But the big thing for the person on Main Street is that the Fed is fully on board in a all-of-government effort to improve conditions, particularly post the pandemic. And I think if there was one message I had to deliver to Main Street is that the Fed will be incredibly cooperative with Congress in doing whatever is necessary to get relief and stimulus to Main Street. We're living in a fiscal policy dominated world, and that is good news for Main Street.
At the same time, Paul, we're getting promising news on treatments, promising news on tests, promising news on vaccine timing. What happens then? I mean, do the vigilantes take all of that and run with it in a year or two?
You mean the bond market vigilantes?
Yes, yes.
Oh, I mean, certainly we could see some steepening of the yield curve as the market takes up long rates relative to short rates. Yes, I think that will happen. But that will actually be a great outcome for the economy at large because it means that we are getting traction in recovery. So the bond market vigilantes are from 40 years ago and have no meaning from the standpoint of the flexibility that the government, broadly speaking, fiscal plus monetary policy, has to nurture a robust recovery.
So, Paul, if you're on the local government side of this, and I'm saying state and local here, and you're trying to manage through this pandemic, maybe you're thinking about bonds or thinking about what kind of spending you can do to help small businesses, to help schools, all sorts of institutions survive. What message should you take away from what the Fed just said?
I think the Fed's message is that Congress should give as much money as possible to state and local governments. So if I were sitting there as a treasurer of a state, my call wouldn't be to Jay Powell about the interest rate on bonds that I could offer. It would be to my congressman, it would be to my senator, it would be to the White House. It would be all about the notion of fiscal transfers to states. That is the key issue going forward, not the precise interest rates on bonds, because states really don't need to be issuing a potload of bonds. They need to have outright fiscal transfers, grants from the fiscal authority at the federal level, which has access indirectly to the Fed's printing press for money. So the big call for the treasurer is to Congress, not to the Fed.